Russian investors are looking to Cuba, Deputy PM says. The trend could boost the Latin American island nation's economy, according to Moscow. Russian firms are considering investing in new hotel infrastructure in Cuba, which would further strengthen the growing economic cooperation between the two countries, according to the Russian Deputy Prime Minister. Dmitry Chernyshenko told reporters on Friday that Russia plans to increase the number of direct charter flights to Cuba soon so that its citizens can have a year-round opportunity for a beach holiday in a friendly country. The announcement was made during a working visit to Cuba by Chernyshenko this week, with the official stating that relations between the two have historical significance and are not subject to political conjuncture. Cuba is our key partner and reliable ally in the Latin American and Caribbean region, he said, adding, "We intend to do everything possible to help the Cuban economy reach a decent level." According to the Russian official, mutual trade tripled last year to $452 million. It has continued to grow, increasing ninefold in the first 4 months of 2023 compared to the same period a year ago. Chernyshenko has also praised the Cuban government's decision to start accepting Russian mirror payment cards as a way to counter Western sanctions. "We are discussing the operating format of Russian banks in Cuba and will transition to ruble-based investment in our joint projects. We hope that the Russian mirror cards will soon be accepted at Cuban resorts, which will have a positive effect on the tourism industry," he said. He also stressed the importance of joint energy projects, which have strategic significance because they are aimed at strengthening the Cuban Republic's energy security. UN chief says it's time to reform Security Council, Bretton Woods. UN Secretary-General Antonio Guterres said on Sunday that it was time to reform both the Security Council and Bretton Woods to align with the realities of today's world. Speaking at a press conference in Hiroshima, Japan, where the Group of Seven, G7, summit had been held, Guterres said both institutions reflected the power relations of 1945 and needed to be updated. "The global financial architecture became outdated, dysfunctional, and unfair," he said, adding, "In the face of the economic shocks from the COVID-19 pandemic and the Russia-Ukraine conflicts, it has failed to fulfill its core function as a global safety net." Elaborating on the systemic and unjust bias in the global economic and financial system, Guterres noted that reforming the Bretton Woods institutions is essentially a question of redistributing power in line with the realities of today's world, as within the current rules, developing economies had been let down and sold short. Guterres added at the G7 summit that there was a growing consciousness among developing countries that not enough was being done to reform outdated institutions or remove the frustrations of the global south. According to the International Monetary Fund, IMF, the wealthy G7's economic clout has shrunk in the past 30 years, accounting for 29.9% of global GDP in 2023 compared to 50.7% in 1980, while China and India together will account for about 50% of world growth in 2023. The Bretton Woods system is a set of unified rules and policies that provided the framework to create fixed international currency exchange rates. Under it, gold was the basis for the U.S. dollar and other currencies were pegged to the U.S. dollar's value. The system came to an end in the early 1970s when the U.S. announced that it would no longer exchange gold for U.S. currency. While the system was dissolved, both the IMF and World Bank it created have remained pillars for the exchange of international currencies. Emerging market investors dump dollar-denominated debt as currency continues global decline. The United States is facing what is shaping up to be a perfect storm of economic bad news, with higher than normal energy prices and inflation compounded by a spiraling debt crisis and fears of economic turmoil amid high-stakes debt limit talks. Meanwhile, BRICS nations are brainstorming a way to de-dollarize the international trade order. Emerging market investors are slowly but steadily moving away from dollar-denominated debt and assets, instead preferring to park their hard-earned money into local currency bonds, an analysis by fund flow and asset allocation data provider Tittle-4 Global has revealed. According to the company's figures, investors pulled out a net $2.65 billion out of primarily dollar-denominated assets between January and April of 2023, but added a net $5.23 billion into local currency bond funds. Market analysts attribute the switch to attractive yields and falling inflation on local bond markets, and an increasingly unattractive dollar amid uncertainty surrounding interest rate-related volatility. The latter put a major dent in U.S. Treasury's attractiveness to investors, and culminated in the collapse of Silicon Valley Bank in March, and panic among investors. Fidelity International Emerging Markets Debt Portfolio Manager Paul Greer expects the trend of weakened demand for dollar-denominated debt and assets to continue for the rest of the year. ABP Invest Chief Investment Officer Thanos Papasavas says there has been a clear divergence between emerging market local and hard currency bonds. Typically dollars and other major Western currencies, ed over the past few quarters with local currency debt looking more attractive on a fundamental and valuation basis. The trend of a cautious move away from the dollar, which continues to hold the coveted status of the world's de facto reserve currency in trade, comes amid the growing risk of the U.S. defaulting on its massive $31.8 trillion debt amid bickering between the White House and Republicans in Congress on federal spending and the debt limit. It also comes as the BRICS group of nations, Brazil, Russia, India, China, and South Africa, brainstorm the creation of a common currency to serve as an alternative to the greenback in global trade, amid growing efforts by Washington to use its currency punitively against countries which fail to align to the Western economic and geopolitical order. Earlier this week, veteran U.S. investor Jim Rogers told Sputnik that the dollar's time as the world's top currency is coming to an end amid the US's lack of neutrality and concerns over the country's creditworthiness. Many people are starting to say, wait a minute, I don't know if we want to use that money, because it will have a problem someday. But also, the world's international currency is supposed to be completely neutral. Anybody can use it for anything they want. But now Washington is changing the rules. And if they get angry at you, they cut you off, Rogers explained. Even America's friends are worried that something could happen to them. Chinese music industry eyes high-quality development, as streaming market grows. The 2022 report on the development of China's music industry was released at the 8th Music Industry Forum held in Beijing on May 19. According to the report, the total scale of China's music industry in 2021 reached approximately 378.76 billion yuan or $54.9 billion, a year-on-year growth of 8.54%. Music giant Tencent Music Entertainment, TME, which owns QQ Music, QQ, and Qwo, published its financial results for the first quarter of 2023 on May 16, eyeing a robust growth of the music streaming business. Revenue from music subscriptions in the first quarter grew by 30.4% year-on-year to 2.6 billion yuan, $378 million, according to the report. Specifically, the number of subscribers increased by 17.7% year-on-year to 94.4 million, which took the online music paying ratio to a record high at 15.9%. The growth of streaming revenues indicates the segment's growing influence in China's overall music industry. TME's strategic emphasis on quality growth propelled strong growth of our online music revenues in the first quarter. The revenue of online music services caught up with social entertainment services for the first time this quarter. The company is committed to developing a sustainable online music business model, TME Executive Chairman Cushan Peng said at a briefing. When it comes to the sustainability of the music business, content is always crucial. In the first quarter, China observed the rising popularity of original musical works for iconic films, games, and animations, as well as independent creators on audio streaming platforms. Music platforms have leveraged diversified streaming services to boost the exposure and influence of talented artists and their original works with the help of short videos and animation IPs. For example, Tencent unveiled a new initiative on its musician platform called the Emerging Force Program. The program offers traffic support, revenue sharing, as well as online and offline performance opportunities to local musicians. Meanwhile, as AI-generated content disrupts the industry, China's music market is riding the wave to promote high-quality development of smart technologies. Chen Duan, head of the Digital Economy Integration Innovation Development Center of China's Central University of Finance and Economics, has said that digitized music products should be the result of efficient platform operation, AI-generated content technologies, and diverse cultural resources. As an industry pioneer, Tencent has been working on an array of AI products ranging from chatbots to music generation tools by further exploring large language models, said Ross Liang, TME CEO. He added that they've energized the platform ecosystem with a broader range of AI-generated content applications, aimed at meeting Chinese users' diverse and nuanced music tastes in new and exciting ways. Recorded music revenues rose 9% in 2022 to $26.2 billion globally, with an increase in paid subscription that has helped drive sales, according to the International Federation of the Phonographic Industry Global Music Report 2023. China nudged into the top 5 global markets for the first time this year, with its streaming media supported by a large base of subscriptions, price advantages, and variety of platforms serving as the major force driving the music market. Use of euro in global payments shrinking, Bloomberg. Swift cross-border transactions in the single currency have nosedived to 3-year lows. The use of the euro for international settlements declined to its lowest level in 3 years last month, Bloomberg reported this week, citing data from Swift. Statistics from the Society for Worldwide Interbank Financial Telecommunications reportedly showed that the proportion of cross-border transactions involving the single currency fell to 31.74% in April from 32.64% during the previous month. Meanwhile, payments using the US dollar climbed to 42.71% from 41.74% in March, while cross-border transactions with the Chinese yuan soared to the highest level in 5 months. The proportion of payments made using the Japanese yen dropped to 3.51% in April from 4.78% in the previous month, according to the report. The share of the dollar continued to expand following the collapse of several U.S. lenders and concerns around Switzerland's Credit Suisse Group AG that ultimately led to its acquisition by UBS Group AG, Bloomberg wrote. The report indicated that, despite the recent drop, the euro is still the second-ranked currency for international payments on SWIFT. Meanwhile, the yuan's use in global trade finance has been steadily growing in line with the government's efforts to internationalize the use of its currency. The renminbi has been playing a major role in international trade as more and more countries strive to reduce their reliance on the Western financial system, and on the US dollar in particular. Russia and its partners have been increasing the use of local currencies in mutual trade, and are also working to establish a new reserve currency amid Western sanctions on Moscow. Cause of Russian export surge to Asia revealed. A heat wave in the region is straining power grids and spurring demand for thermal coal and fuel oil, Bloomberg reports. Asian imports of Russian energy used for electricity generation have surged in recent weeks due to high demand amid unseasonably warm weather, Bloomberg reported on Sunday, citing ship tracking data from Kepler. According to the report, coal imports surged to 7.46 million tons in April, nearly a third higher than at the same time in 2022. Deliveries of fuel oil, meanwhile, were the highest on record in both April and March, the data showed. Both fuels are most often used by power grids. China and India were the largest buyers of Russian energy last month, accounting for more than 2/3 of the country's coal exports sent to Asia. Both nations increased their energy imports from Russia last year, taking advantage of discounts offered in an effort to secure new markets as Russian exports were shunned by Western buyers amid Ukraine-related sanctions. South Korea, Vietnam, Malaysia, and Sri Lanka have also become significant buyers of Russian coal, while Saudi Arabia and the UAE have stepped up purchases of its fuel oil. Analysts say that deliveries to Asia are set to further increase in the coming weeks due to the emergence of El Niño, a recurring warm climate pattern that influences the weather and could cause droughts in the region. According to a study published in the journal Science this week, this year's El Niño is expected to develop between May and July and is likely to be especially strong. According to John Driscoll, head of JTD Energy Services Pte in Singapore, the growing demand for Russian energy in Asia also shows that many countries are choosing energy security over political interests. The worst place to be right now amid these searing temperatures is South Asia, especially poorer nations like Pakistan or Bangladesh. When you can't even take care of your people's basic needs, it's very hard to care too much about international affairs. They are asking themselves, would I rather risk falling afoul of the US or forego steep discounts on energy? When there's a good deal on the table, how can poorer nations afford to say no? Driscoll told Bloomberg. Cause of Russian export surge to Asia revealed. A heat wave in the region is straining power grids and spurring demand for thermal coal and fuel oil, Bloomberg reports. Asian imports of Russian energy used for electricity generation have surged in recent weeks due to high demand amid unseasonably warm weather, Bloomberg reported on Sunday, citing ship tracking data from Kepler. According to the report, coal imports surged to 7.46 million tons in April, nearly a third higher than at the same time in 2022. Deliveries of fuel oil, meanwhile, were the highest on record in both April and March, the data showed. Both fuels are most often used by power grids. China and India were the largest buyers of Russian energy last month, accounting for more than two-thirds of the country's coal exports sent to Asia. Both nations increased their energy imports from Russia last year, taking advantage of discounts offered in an effort to secure new markets as Russian exports were shunned by Western buyers amid Ukraine-related sanctions. South Korea, Vietnam, Malaysia, and Sri Lanka have also become significant buyers of Russian coal, while Saudi Arabia and the UAE have stepped up purchases of its fuel oil. Analysts say that deliveries to Asia are set to further increase in the coming weeks due to the emergence of El Niño, a recurring warm climate pattern that influences the weather and could cause droughts in the region. According to a study published in the journal Science this week, this year's El Niño is expected to develop between May and July and is likely to be especially strong. According to John Driscoll, head of JTD Energy Services Pte in Singapore, the growing demand for Russian energy in Asia also shows that many countries are choosing energy security over political interests. The worst place to be right now amid these searing temperatures is South Asia, especially poorer nations like Pakistan or Bangladesh. When you can't even take care of your people's basic needs, it's very hard to care too much about international affairs. They are asking themselves, would I rather risk falling afoul of the US or forego steep discounts on energy? When there's a good deal on the table, how can poorer nations afford to say no? Driscoll told Bloomberg. Russians encouraged to ditch dollar for gold. The government had previously scrapped a tax on bullion purchases. Gold ingots of up to 20 grams may now be purchased on the Moscow Mint website, the Goznik Joint Stock Company, which operates the mint, announced on Wednesday. The move is part of a broader agenda to encourage Russians to shift away from US dollar savings. According to the company's statement, Russians are now able to buy, sell, or store their purchased gold bars and coins. Goznik is planning to make gold ingots weighing 50 grams available for purchase on its website, the company said, adding that the services will be accessible both in the trading salon of the Moscow Mint and through the Goznik.Investments app. The storage period of ingots at the Moscow Mint is unlimited, while Goznik guarantees the buyback of all bullion in the Mint's vaults. It will also accept ingots that have been in circulation if there is no visible damage on them or on the packaging. From April 1, Russian precious metals refineries, Goznik, and the country's banks have been allowed to sell gold bars to individuals with no value-added tax, VAT, applied. Last March, Moscow scrapped its 20% VAT on individuals making physical gold trades, in an effort to draw people away from US dollar holdings, a common way in the past for Russians to protect their savings. Previously, when buying physical gold, Russians had to pay 20% of the purchase in VAT. When selling the precious metal back to the bank, the paid tax was not returned to the investor. As of November 2022, Russians purchased more than 50 tons of gold bars, 10 times more than the previous recorded period. The most sought after were 1 kilogram bars, which accounted for about 60% of the total bought. China replaces Japan as world's top car exporter, media. The country's sales in the first quarter jumped by nearly 60% year-on-year, according to Nikkei. China became the world's largest car exporter in the first quarter of 2023, Nikkei news outlet reported this week, citing data from the China Association of Automobile Manufacturers. According to the report, Chinese car exports in January-March soared by 58% against the same period in 2022, to 1.07 million units. During this period, the former top exporter, Japan, sold 950,000 vehicles. Data shows that the growth in China's car exports was spurred by rising demand for electric vehicles and increased deliveries to Russia. Exports of new energy vehicles, which include EVs, jumped 93% year-on-year to 380,000 units in the first quarter, and accounted for around 40% of China's overall car exports. Tesla's China arm was the largest contributor in new energy vehicle exports, selling 90,000 units in the reporting period. Tesla's first quarter exports from China grew 20% from a year earlier. China's exports to Russia more than tripled in the reporting period from a year earlier to 140,000 units, making Russia the top export destination for Chinese vehicles. Following the start of Russia's military operation in Ukraine, a number of global automakers left the country due to Western sanctions, which jeopardized supply chains and made financial transactions with Russia problematic. Chinese automakers eagerly seized the opportunity to expand their presence in the Russian market. Chinese auto exports continued to grow in the second quarter. From January to April this year, the country's car companies exported a total of 1.37 million vehicles. Last month, the export volume reached 376,000 units, a month-on-month increase of 3.3% and a year-on-year increase of 170%, data shows. Last year, China's car export volume reached a record high of 3.11 million vehicles, which made the country the world's second-largest car exporter after Japan. The China Passenger Car Association predicts that exports will reach 4 million in 2023. Seized Russian superyacht costs Antigua a fortune, Bloomberg. The luxury vessel allegedly owned by a fertilizer tycoon has been piling up huge bills, the outlet reported. The sanctioned superyacht Alpha Nero has racked up vast unpaid bills since being moored in Antigua's Falmouth harbor last April, Bloomberg reported this week. It reportedly costs tens of thousands of dollars per month just to keep the vessel afloat. The yacht, which is believed to be owned by sanctioned Russian fertilizer billionaire Andrei Guryev, measures 82 meters and boasts luxury amenities that include 7 staterooms, a gym, a spa, and a pool that doubles as a helipad. The Alpha Nero has not been moved since arriving on the island, part of the Caribbean nation of Antigua and Barbuda, after the US and the UK imposed sanctions on its purported owner following the outbreak of hostilities in Ukraine last year. The $120 million floating palace was recently deemed a hazard to the harbor and marine environment as it needs to burn diesel constantly to power everything on board. The crew of the vessel has not been paid, nor has the provider of the fuel that the vessel has consumed since its arrival on the island. Of the 44 crew members, only 6 remain on the yacht, while 25 members have sued to recover $2.1 million in unpaid wages, Bloomberg wrote, citing Craig Jackas, a local lawyer representing them. Crew expenses alone cost $112,000 a month, the news agency said. Our client's objective is simply to secure what is lawfully owed to them, Jackas said. Antigua and Barbuda authorities have asked the U.S. to lift the sanctions on the yacht so that they can sell what they consider an abandoned ship. Nobody's laid claim to it, nobody's been paying its bills. It's been running up money left, right and center, and it has become a risk to the harbor itself, Sir Ronald Sanders, the country's ambassador to the U.S., told Bloomberg. The Antigua and Barbuda government has said it has received 20 bids for the vessel. However, the Alpha Nero cannot be auctioned as long as the U.S. considers it a blocked property. Last week, the Caribbean nation's authorities announced they were drawing ever closer to selling the superyacht to a buyer. The proceeds from the sale will go towards paying the debts incurred since the vessel sailed into Antigua's harbors more than 1 year ago. The overage will go into the consolidated fund operated by the Antigua and Barbuda Treasury, the government said in a statement. The U.S. and its allies have imposed sanctions against a number of wealthy Russians over the past year in response to Moscow's military operation in Ukraine. More than 24 luxury vessels worth about $4 billion have been impounded in ports around the world. Global debt balloons to record highs. It's now $45 trillion higher than its pre-pandemic level and is expected to continue growing rapidly, a top trade body has warned. The global debt pile increased by $8.3 trillion in the first quarter of the year to a near-record high of $305 trillion amid an aggressive tightening of monetary policy by central banks, the Institute of International Finance, IIF, has revealed. According to its Global Debt Monitor report on Wednesday, the reading is the highest since the first quarter of last year and the second highest quarterly reading ever. The IIF warned that the combination of such high debt levels and rising interest rates had pushed up the cost of servicing that debt, prompting concerns about leverage in the financial system. With financial conditions at their most restrictive levels since the 2008-09 financial crisis, a credit crunch would prompt higher default rates and result in more zombie firms, already approaching an estimated 14% of US-listed firms, the IIF said. Despite concerns over a potential credit crunch following recent turmoil in the banking sectors of the United States and Switzerland, government borrowing needs to remain elevated, the finance industry body stressed. According to the report, aging populations and rising healthcare costs continue putting strain on government balance sheets. While heightened geopolitical tensions are also expected to drive further increases in national defense spending over the medium term, which would potentially affect the credit profile of both governments and corporate borrowers. If this trend continues, it will have significant implications for international debt markets, particularly if interest rates remain higher for longer, the IIF cautioned. The report showed that total debt in emerging markets hit a new record high of more than $100 trillion, around 250% of GDP, up from $75 trillion in 2019. China, Mexico, Brazil, India, and Turkey were the biggest upward contributors, according to the IIF. As for the developed markets, Japan, the US, France and the UK posted the sharpest increases over the quarter, it said. Russia reverses tax hike plan for workers abroad. Personal income tax for employees who have left the country will remain at 13%, a deputy minister has announced. The tax rate for Russian citizens who work outside the country will remain unchanged regardless of their tax residency status, the finance ministry announced on Thursday. Personal income tax for employees who have left Russia and work abroad under labor contracts or civil law agreements will stay at 13 to 15%, Deputy Finance Minister Alexei Sazonov said. In 2021, Russia implemented a progressive tax system with a basic rate of 13%, rising to 15% for those earning over 5 million rubles, $61,500, per year. Regardless of their status, Russian tax resident, non-resident, their income will be taxed at the personal income tax rate of 13 to 15% provided for Russian tax residents, Sazonov said in a statement. Clarification of the types of income of remote employees and the application of a single tax rate will significantly simplify the tax administration mechanism for tax agents. The announcement was made after the government postponed the adoption of a draft law that proposed to more than double the tax rate for workers abroad. In April, the Russian government submitted a bill to the State Duma that would oblige companies to levy a 30% personal income tax on payments to Russians who have lived abroad for more than 6 months and have lost their tax residency status. The controversial bill was withdrawn a day after being submitted. According to the Cabinet of Ministers, the bill required a number of technical clarifications. The finalized version of the tax amendments has now been sent to the Russian parliament, and if approved will come into effect from January 1, 2024.